Hey everyone! What an exciting episode we've got for you today. I'm very excited about it. I'm, of course, John Turner with the Turner Victory Team at Onward Real Estate, and we look at the stats every week for the Rutherford County real estate market. But I'm doing something a little bit different here. At the end of this, I've got some really good information um, from basically looking at appreciation, historical appreciation, and using some of that to predict where I think the market's going to go. Now, y'all know most of the time I stay away from predictions. I like to provide more stats, but there's just something that's been on my heart I've really been looking at, and I think you're going to find it very useful. So whether you're a buyer or you're a seller or you're one of the many real estate agents that use this information to help your clients out, stick around to the end because I really think that's probably going to be the most important information that we talk about today. All right, so let's go ahead and get into this week. As you know, we always start with this chart right here. This is looking at the information basically ending on August 24th, and as you can see, we have 1,532 active homes on the market right now. That is down slightly. We have been floating around 1,550 homes, give or take a little bit, over the past 7 weeks. So inventory's been remaining very even. New listings this week, 103. We'll look at that here in a second. Pendings, we'll really talk about that. That's 129. There was 101 homes closed this week. 1,423 or 21 homes have closed in the past 3 months. If you look at this too, 8.42% of the homes that were on the market actually went under contract. So one thing that really jumps out at me whenever I look at the month supply here is that every single price range is below 6 months. If you recall, 6 months is considered a balanced market. Anything below that is a seller's market. I know you're hearing it in the headlines. I know you're hearing it from other agents. You're hearing it from whatever, that this is a buyer's market. It feels sometimes like a buyer's market. But by definition, we are in a seller's market and a fairly healthy seller's market. The difference is, I feel like the difference is, and I'm always careful to go off a feel because I like data. Because if we're going off feelings, we feel that it's in a seller's market. But it seems like buyer activity is down and there's not as many showings on houses. Let's talk about that for a second. One of the great things that has come about through the COVID years is that people got used to buying homes sight unseen. And we're not seeing that as much anymore. But what buyers are able to do is they are able to eliminate a lot of homes based upon the way they look online. As agents, we've done a lot better job of getting information out there. We can get floor plans out there, walk through videos, all sorts of different things. So buyers can really narrow down the number of houses they look at. So showings, and we will get into some showing data here in a minute, by the way, but showings are down, or at least they feel like they're down compared to pre-COVID years. But that's because so many people got used to making decisions. I mean, you look at Amazon. We buy on Amazon, sight unseen. So many things are done online. It's just it usually does not take a buyer as many showings to look at something. Also, buyers are a little bit more hesitant right now too, so that makes it feel like a slower market as well. So, but whenever you look at the data here for month supply, we definitely are still in a seller's market, and in 4 of the 9 price ranges, we have under 3 months supply. So very interesting information there. New listings. Let's look at this. Our new listings are down 2 weeks in a row. They were mimicking kind of what we did in 2024, but if you look at the light blue line, we are down. If you notice this coming week, last year, we had a huge spike in new listings. It'll be interesting to see what this week holds, whether we will see that spike back up or we'll continue a trend of lower new listings. Month supply, let's look at let me get to the right graph here. You can see we're still floating around. We were at 3.3. We're 3.23. Just been pretty steady right here. Kind of goes with this time last year. It was pretty steady, right in the 2.3, 2.4 last year. So we are about a month higher in supply this year over last year. Let's look at our pending chart. The red is this year. And if you notice these past 2 weeks, we've seen quite a bit of increase. As a matter of fact, this week, our 129 units was about 21% year over year from last year. The last time we had a spike on that, now we're in week 34 right now, so you have to go back to week 20. So 14 weeks ago, so 3.5 months ago, did we have a spike there? And we also had one here around week 12 or week 13. But those are, that is an interesting look at it. So if you look at the past 3 of the past 5 weeks, we have had higher pending numbers. Will that sustain? I really don't know, but it will be interesting to see. Our available inventory chart, you notice how we topped out right here at 1576, and we have actually eased a little bit, but we're still in that mid 1500 marks. And then we'll look at our pending percentages also. If we look at the graph, this is interesting that 8.42% of the homes on the market went under contract. That's getting a lot closer to what we saw about this time last year, and it's definitely an increase. It's the highest level we've seen in quite a while, going all the way back to week 20 of this year, which goes back to exactly what I was talking about, where we saw that huge increase in pending. So some interesting information there. Let's talk a little bit about showings, because that's a hot topic with my sellers. Man, it just seems like maybe showings are down. Well, there's two different sites where we can get our showing information from. Some companies use a company called Showing Time, and some use the MLS Real Tracks to set up their showings. So we kind of have to pull all that information together because it's not one central location. But if we go over to Showing Time, it's real easy to pull this little chart right here. And what I've done is I have to do it by zip code, so I've pulled up many of the zip codes in Rutherford County, not all of them, looking at all the price ranges. It's so funny, nothing below 200,000, well, you know that. But this is showing the number of showings that we've had in the past 30 days, okay? A little bit harder to read right there. It's a chart, so this is the easier way to read it down here. In the 200,000s, we had 160 showings, okay? That means we had 6.4 showings per listing on average in showing time. Anything that was listed with showing time. I also had about 6 listings or showings per listing in the 400s, or in the 300s, sorry. In the 400s, dropped down to 5. In the 500,000, in the past 30 days, we've had less than 4 showings per listing. So just very interesting. To break this down, I will include this in the email that I send out. If you're not on the email list, you need to be on the email list. Just comment on this, or you can email me at John, that's JOHN, at turnervictory.com, and I will make sure you go on my email list. But that's one place that we can look and find showing information. The other place is under Real Tracks. And whenever I go here for the past 30 days across the board, this is not broke down price range, we've had 6 showings per listing in any price range in the past 30 days. So, and that's on par with June. Actually, I think I had this set up for 30 days, but I think it defaults to months. So in July, there was 6 showings. June, there were 6 showings. Obviously, in April, that was up. Look back in November last year, election going on, right? There wasn't near as much going on. So if you're wondering about showings, you should be able to pull this information. If not, I'm more than happy to get this to you. All right, let's switch gears a little bit. Something that you've heard about a lot in the news, or maybe you have, but the Fed met in Jackson Hole, Wyoming, and what has come out of that is that the Fed Chairman Jerome Powell has made it clear that he's ready for rate cuts in September. Okay, so woo, rate cuts. Probably should have done it a little bit sooner. My personal opinion. I'm not an economist, but my personal opinion, probably should have done that a little bit sooner. because I feel like they might be a little slow, to the ball game. But all right, so everybody, you wait till September and whenever they meet, and there's going to be whenever they drop rates, assuming they do, but pretty much everybody's assuming it's going to be 0.25% drop. It could be 0.5% or 50 basis points, however you want to talk about it. But right now, the markets are figuring there's about a 90% chance of a 0.25% drop. So the headlines and what you're going to hear come September is you're going to hear about the Fed cutting rates. And everybody's going to get all excited. And I get that. And everybody's going to say, oh, maybe I should buy a home now. But the rates they're cutting are not mortgage rates. Okay, that's what a lot of people don't understand. Some people do, but the rates that they're going to cut are basically the rates that banks loan money to each other at. So that helps things like if you have a home equity line of credit, so that will really help you a little bit. Maybe a car loan, consumer debt, it should help with credit card, interest rates, things of that nature. Mortgage rates, it really will not have an effect. And I'm going to show you why right here. So if you look at this, let's go to the next thing. Let's look at what has gone on with the 10-year Treasury. I always talk about the 10-year Treasury. All right, here's where we are, if you can kind of see that. And look at this yellow line right here. This yellow line, only August, the first week of August is below the yellow line. If you look at that dip, you also right at the end of June barely got to where we are now. So basically, we are at the next lowest point with the 10-year Treasury that we have been in the past 3 months at least. So why does that matter? Well, let's go back. I can't go back day. Let's go back to the 5-day though and let this populate. Look at this right here. Can you see this drop right here? When is that? That's Friday. That was Friday morning. Why did it drop? The 10-year Treasury dropped because Jerome Powell said, hey, I'm ready to start dropping interest rates. The 10-year Treasury, the mortgage rates pattern themselves a lot after the 10-year Treasury. Basically, you could take the 10-year Treasury rate, which right now is 4.269. You can see that up here. And you can add somewhere between 1.8 and about 2.5 to that. And you'll get what mortgage rates are. The 1.8 and the 2.5, that fluctuates based on a lot of things. When the markets were really good during COVID, like really moving, most of the time that was 1.8. If it were 1.8 right now, our mortgage rates would be about 6%. Okay. It's not that. So our mortgage rates, and I'll try to pull that up in a second and show you where we are on that. But the markets have already taken into account the mortgage rate drop, okay? Or the interest rate drop. So mortgage rates have reacted. They reacted Friday. If I were in the process of purchasing a home, I would certainly reach out to my lender and see if there's anything that I need to do, what rates are doing Monday morning. Do I need to go ahead and lock in? I'll share with you a very quick story. Right here, we were supposed to close on a house. I had the seller, and we were supposed to close the second Monday of August, if I remember correctly. And we got a call from the buyer's agent and said, would you mind delay closing? I said, what's going on? Why do we need to delay closing? Everything all right? And what had happened is right in here, because the 10-year Treasury dropped, mortgage rates improved a little bit, but the cost, the points you pay to get a mortgage, dropped quite a bit. And it was going to save this buyer probably about $3,000 in closing costs in order to be able to close on that loan. So they asked us, they said, hey, can you delay 2 or 3 days to closing because it will save us a lot of money? Fortunately, my seller was very kind-hearted in a position where she could do that. We did that, made that buyer really happy, was able to save them some money. So I would check right here with my lender and really see if there may be some benefit to you going ahead and locking in. So let's jump over to just real quick. Let's look at where we are on the mortgage rates this week, the way we ended it. if my internet will work quick enough here. I got so many things running. I don't know whether it will or it won't. So let me drop that off. I'll just sit here in the quiet. Wait a minute. Let's go on while I'm waiting on that. Let's talk about appreciation. Okay, this is the appreciation. Did you know since 2005, a home in the Nashville-Davidson County area has appreciated 233%? That's just unbelievable right there. The average appreciation is 5.9%. I'll tell you what, I think this is pulling... thing is, I went to the wrong page. So here we go. All right. This should give us our week ending number with our graph here. If it will load in. I don't know why I'm having such a slow time with this. Let me try to get to the 1 year because it's a little bit easier. So 6.58, 6.58. So we were pretty much flat the way that we ended the week. But look at that. That's Thursday, August 21st. It doesn't take into account Friday. So it'll be interesting next week when that takes into account Friday. So basically flat for the mortgage rates right there. If you look at this annual appreciation, this is for the Nashville, Davidson, Murfreesboro, Franklin MSA. And you can see from 1992, 4.4, 6.4, 7.3, 8.6, 4, 3, and then we had 2008, 9, 10, 11. Remember that? And then look at the 25% in 2021. Right now, for 2025, we're at 1.4%. The new charts are actually coming out Tuesday, so I do not have that information yet. But I've really been thinking about this, really been reflecting on this. So what I did is I went and pulled up a house. Actually, here's 4 of them in Evergreen Farms. If you live in Rutherford County, you know where Evergreen Farms is. And pulled up, there's 3 of these right here that all sold for the same amount. The 1240 Planball South. This one was a little bit higher. But if I click on this one and we look at it, what we're going to find out is that it sold for $96,400 in January 11th, 2000. Okay, brand new house. I know. I wish we all could go back and buy 800 of these. I get it. We didn't. Some of you did. I know some people who did, but 96,400. So what I have done is I have taken the appreciation charts and have projected out 2 things. First of all, what a house would sell for, roughly what it would sell for if it's that same plan or close to that plan in Evergreen Farms in today's market. And then I'm looking at what it would have done if appreciation would have averaged the same that it did before we got to the COVID years. Does that make sense? So I kind of walked through it here with you. So what I did is, look right here. We were running about 4.2% appreciation on homes. Okay, that's about where we are. So if you take the 96.4 the first year, second year you go down, and if it's at 4.2%, it would have been worth $100,499. Actually, if you put the charts on, it was $100,333. So only $116 difference, pretty close. Then we gone up to 104. Should have been. I mean, actual was 104. The 109 actual was high 108. So you see how all this is running around that 4.2%. I mean, we even get up to here in 2019. At 4.2%, it should sell for 210. Actually, it sold for 206. So within, a few $1,000s. But then let's look at 2020. We know what happened in 2020. It should have appreciated to 219,000. It appreciated to 225. Okay, that's in Q1 of 2020, right? Then it should have been 228. If it stayed at 4.2%, it went up to 247, 18,000 higher than what it would have been if it stayed at 4.2%. Does that make sense? Then it should have been at 238 at 4.2%. It went to 270, $32,000 higher. All right, you see what I'm doing? Take it down to 2025. That same house should be roughly 269 if we continued to go at 4.2%. This says actually it's about 355. Well, is it 355? Yeah, let's look and see. My friends Chris and Don Day just had one listed on Holstead Drive. Now this is a 1275 plan, okay, not the 1240, but pretty close. What did it sell for? 359. When did it sell? It just sold past week or two, right? So that same house that would have been roughly 96,000 now is 359. But if it would have stayed at 4.2%, it would be 269. So values went up so much that they are $85,000 in this example over what they should have been if it remained the same. Now, what does that mean? I mean, it did what it did. It's where we are, right? I mean, it's just where we are. Well, I'm not an economist, but I do know that there are certain things that are true about markets for the most part. And one of them is they run in cycles. And there's things that are kind of quote unquote normal in those. And what has happened is that this right in through here, especially the past 4 years, got out of quote unquote normal. Markets like normal. So for a house at 355 in there, really, if it stayed at 4.2%, it should be somewhere here between, it should have hit that around 2031 or 2032. Okay? I mean, if it would have kept appreciation. So right now on that house, we're at 2031 prices. So what's going to happen? That's the big question. There's a couple of things that can happen. One is, well, there's probably about three things. One is we may never go back to normal. Okay? That's just not really the way that markets go. But also, I will say that there's a lot of things that go on behind the scenes and a lot of things in this day and age that aren't quote unquote normal. So I will never guarantee that we're going back to that quote unquote normal. Okay? But assuming that we are, we could either drop, this price could drop and drop down to 280 and lose, quite a bit of value. It's very rare that that happens, by the way. Very rare, no matter what the market conditions are. Or the more likely thing is a combination of things. One, the market levels. So next year, this is worth 355, 345, I don't know, 365. But you don't see near as much appreciation. And I think it's also possible that the average appreciation just will remain higher than 4.2. I feel like this market, and with everything we got going on here, probably likes a 5% appreciation better. So what I have also done here, and let me get this a little bit smaller because I had it pulled off the screen so it wouldn't bother us. But also what I have done is I have brought in these numbers assuming a 5%. So this is where we were at 4.2% appreciation. This is actual. But right here at 5%, if we would appreciate at 5% over all these years, we would be at, that home would be worth $326,000. It sold for $355,000. Okay? So not real far off. Next year, at 5%, it would be worth $342,000 and then $359,000. It's at $355,000. Personally, and again, this is my prediction on it. Personally, I think we are going to see a combination of two things, and really they work together. It's really, I think we're going to see a leveling off of home prices, and I think we may see a slight decrease to help us get back to that normal, somewhere around 5% over the past 20 years, basically, is where it would put us. So do I see a crash coming? No, I haven't seen a crash coming at all. I don't think prices are going to continue to just go crazy. There's a couple of wild cards on here. First of all, mortgage rates. If for some reason they just, the bottom drops out of them, that changes all this. I don't see that. I think I bursted some people's bubble. We had open house this weekend, and they wanted to start investing in real estate. And they were waiting for 3% rates to come back. And I think we're going to be somewhere between 5 3/4 and 6 1/4, and we're probably going to be there for a while. Is my guess. I think we will work our way down there in the next few months, and that's where we're going to stay. So between that, the mortgage rate's not really dropping a whole heck of a lot, and prices only dropping a little bit. We need that little bit of time for wages to start catching up to help with affordability. So I really think that's kind of what we're going to see right there, because it all comes down to affordability. The other wild card is builders. A lot of builders are starting to pull back right now. They're a little bit nervous because they got too much inventory. They have stockholders they have to appease. And my fear is, as we see this pent-up demand come back into the market, especially if we can approach that 6% mortgage rate, I really think that we could have some issues, because we're still not getting a whole heck of a lot of inventory out. It's been remaining, constant around that 1,550 mark, and that could be ate up pretty quickly. And if builders are not putting products out there, because right now that's about a third of our market, I really think that we could have a little bit more shortage, which then would put upward pressure on prices. I hope that's not the case. I feel for people trying to get into the market right now. It's a little bit tough. But one other thing I will share with you, if you look at the projections, look down here, even though we're looking at a $355,000 house, if you look at the projections at 5%, if you look at the projections at 4.2%, and this is 4.2% from 269, not 355, you still see that over the long haul, investing in real estate is a really good investment. Plus, just being in a house, it's a quality of life thing. So I hope this helps. It's certainly the best explanation I have of what's I think is going to happen with the market. Take it for what it's worth. It's worth about what you paid for it. So, but anyway, check it out. Please comment below if you let me know what you think is going to happen, and also please subscribe to this channel. It means a lot to us when you subscribe. It certainly helps us out, and we're trying to provide good information for you, and that way you'll be alerted whenever we do post these. And I hope you make it a great week, and we'll see you next week.